of the great new option tools, including the brand new simulated returns. Everyone thought that was pretty cool last night. That's the latest feature that we're going to show, as well as some of the other new options chain enhancements that we've rolled out recently. So this is going to be equal parts education and entertainment. So stick with the racing theme. Let's buckle up. Quick note, this content in this session is for educational purposes only. Does not constitute tax or investment advice. Is not a recommendation for any security or strategy. Lastly, options are risky and not suitable for all investors. So please review the characteristics and risks of options before placing a trade. And in case you're wondering how you get that, we put it in your swag bag when you checked in. So you guys have that. Without further ado, let's meet our panel. First up, you know him from CNBC's Fast Money. He's also the founder of Risk Reversal Media, my good friend, Dan Nathan. Next up, our technician for the next hour, founder and CEO of Worth Charting and known affectionately on CNBC as the Chart Master, Carter Braxton Worth. Now, education is near and dear to my heart, and our next panelist is one of the best in the business, chief strategist at Options Play, and also a CNBC contributor, Tony Zhang. And last but certainly not least, joining us from one of our sponsors, SIBO Global Markets, where he serves as Vice President of Market Intelligence, Henry Schwartz. All right, guys, so here's the ground rules. We asked Vlad and team for a little bit of money on this trading account, so we've got, let's get the screens on if we can. We've got $30,000 in our trading account, so fresh account. We are going to be placing 5 trades in the next hour. So we're going to move fast and quick, but we want this to be interactive. So if you have questions, we've got 2 spots, I think, where we might have some mics for you guys. So if back of the house, if we can show those real quick, let everyone know where they can come up and ask questions. We ask just one thing. Try, if you can, to make the questions about the trade we're talking about. And if it's going to pull us off track a little bit, we might put it in what I call the parking lot. And we can answer at the end of the session. If we run out of time, find us over by the booth. We'll answer your questions later. So 5 trades, and we're going to do increasing complexity. So we're going to start simple. We're going to get more advanced with each trade. And along the way, we're going to show off all the great tools on Robinhood Legend. Are you guys ready to go? That's not good enough. Are you ready to go? Yeah. There we go. All right. So for our first trade, guys, let's talk about the general market. We're going to bring up QQQ. Anyone here trade the Qs? All right. Dan, I know you're a bit of a tech guy.
I'm a bit of a tech guy.
You're a bit of a tech guy, and you like talking macro. Set up the theme right now, especially after last night. We got Oracle's earnings, which just blew away the market. NVIDIA's up. Some of these other components are up today. What are we looking at right now in the tech market and the NASDAQ?
It also blew away the shorts, Obi, and it's a good thing that you guys didn't launch shorting until last night. Okay, yeah. So let's just take a look at that. You know, the QQQ, the NASDAQ 100, we all know the story. It's a really concentrated ETF, right? Some folks would say, you know, this is how I get exposure to generative AI, right? The top 10 names in that ETF make up 50% of the weight. Now, that presents also an opportunity because we know over time the QQQ has been a monster, right? If you want to invest in innovation in this country, that's where you've had to be. But there's also another, right? There's 100 stocks in the index of 100. There's another 90 stocks in there. Some of them are dogs. Some are going to get kicked out, that sort of thing. They're going to move their way lower because of market cap terms and all that sort of stuff. But there's probably a couple dozen in there that are going to be the next, I don't know, Oracle, you know, who knows, right? So I really love the QQQ as an investment vehicle, but it's also a great trader, right? And I look at what's going on today. Oracle's up 40%. It's creating hundreds of billions of dollars in market cap that it's gained. But look at the QQQ right here. It's not up a whole heck of a lot. A lot of the other participants in that top 10 are not doing that well because Oracle is taking market share or something else is going on from there. So if I'm thinking about my exposure in my portfolio, I might think about a QQQ and I would say this is a good hedging vehicle, right? If I have a lot of exposure, and that's another widget you guys are adding, another service, you can compare your portfolio to a major index or an ETF like this. And I think that's a really cool tool. So when I think about the QQQ, it's up 13% on the year. And I say, where is the level? Maybe Carter can bring up a chart really quickly on a technical level that might help inform a little bit. Carter, talk to me about that breakout level, because that breakout level has been off to the races. You've seen that consolidation there. It looks like it's breaking out new all-time highs. What do you do with that? Where are my levels to the downside if I'm thinking about some put protection, either long premium directional or just a hedging sort of strategy?
Sure. So in this aggregate, as is the case with almost all stocks and most aggregates, has its peak pre-tariff. That's February 18th. It plunges. The S&P dropped 21%. This dropped more. They all pivot on April 7th. And then it's a question of which indices have recouped all the losses versus not. We know, for instance, that the equal weight S&P is not back to a new high. We know that mid-cap isn't. Now, this one's well through the pre-sell-off high. You see how it gapped up, of course, when it just got back to those highs about 2-3 months ago, and now consolidating a bit. The question is, and this is interesting, and you make this point in, it's not up that much today with this very big move in a very big constituent. In fact, the equal weight S&P is down today. The mid-cap is down. The transports are down. There's not a lot of follow-through, which is suspicious. And as you're pulling it back there, it's right back to its high of about a month ago. My hunch is that it will be not volatile here and now, and that there's not a lot of follow-through. So if I were long this, I would be selling premium.
All right, but I'm going to buy premium here. So, that's what makes a market here. And so I want to look out to November expiration. That's the third Friday in November. Why do I want to look out that far? Well, we know in a few weeks we're going to start getting earnings, right? So we're going to start hearing what these companies had to say, how they printed in that prior quarter, how they're thinking about their business right now. They might also start giving next year guidance. That was one of the big drivers of this Oracle print last night. They basically gave fiscal year 2026 guidance, was way above what a lot of folks were expecting, right? So if I look at the QQQ, I'm looking at the at-the-money 582, Obi, if we want to pull up that. And I'm saying to myself, okay, if I look at the straddle, these guys are going to deal with more complex strategies, but 6.5% implied movement up or down in the QQQ between now and November's expiration. If I just look at the put, it's about 3%. If I look at the call, it's about 3%. So if I'm bullish and I want to buy an at-the-money call, it costs me 3% of the underlying ETF, right? Same thing goes for the put. I kind of like that here. I like the fact that we've actually been dragged up by a handful of names. I like the fact that we're coming into earnings. I like the fact that there's a lot of enthusiasm about these biggest generative AI names. So I'm going to look at the at-the-money put, the November 580 put. And what do we see it offered there, Obi? I can't see behind my shoulder.
You want, you said the 582 put, right?
Yeah, 582.
582 is trading 1692 right now. You know, a new feature I also want to add to our option chain, Dan. So what Dan was doing there, trying to figure out what the expected move was, is kind of an old floor traders, old traders trick where...
You call me old?
Well, you got some grays.
Oh, got a lot of grays.
I'm starting to get some grays here.
I see that, Obi.
What you can do is you sort of just queue up the at-the-money straddle, which is just buying the at-the-money call and put. We've got a price of that straddle of about $38. You divide that by the price of the underlying. But here's the first tool I want to show off, Dan. We've added some new data to the option chain. If you go to your menu here in the upper right-hand corner and hit Display IV and Expected Move, we do the math for you, sir. So looking at that November expiration, November 21st, we've got implied volatility of 21%, an expected move of $45. Tony, my friend on the other side, explain that to me like I'm 5. How do we use this data to sort of inform what we can expect Qs to do most of the time?
Yeah, so the thing about buying a put option is that you have theoretically unlimited downside potential all the way to 0. But you have to try to figure out between now and that November expiration, how far is Qs realistically going to go? And that's really kind of what that expected move tells you. It gives you a good sense, roughly, in a normal market, how much can Qs move by from what the options markets are implying. And that's helpful, especially if we start graduating into trading spreads. We'll talk a little bit about that in a second here. But like one of the things that I really like here about this particular trade is, you know, you've got this 580 double top here on the Qs. That's a good sign of potentially a place where this could reverse lower. You've got what seems like divergence pretty much starting from May. So you have signs of buyer exhaustion all the way from May. the divergence away from the equal weight index. We started to see that starting in early May. So we've had, you know, a good 3.5 months now of this divergence. And usually when those things unwind, you tend to get these quick, violent moves to the downside. And I think that's why buying a put option here is the right structure, because that gives you limited risk if the Qs continue to move higher, right? So if it breaks out higher here, I would get out very quickly at a small loss. You have a limited loss to the upside, but you have unlimited downside potential. So if you do get a quick, fast move to the downside, the put structure is a really good way to try to take advantage of that. So, you know.
Oh, sorry, go ahead.
And I would just say, for myself, I think I prefer something a little shorter dated, because in this particular example, I want gamma. I want to have that acceleration, that convexity. And you get that more so when you're trading a shorter dated option. And I prefer to trade a shorter dated option, maybe buy a couple if I need to, rather than buying a long dated.
About, Tony, is more of a trade, right? When I'm thinking about this, the way I'm laying this out, if my portfolio tracks towards the QQQ, and I don't want to sell some of these individual names, because look at like what we just saw in Oracle, right? I want to keep some of those theses intact, right? So I'm thinking about it more as a hedge, right? And so one of the reasons, though, that we have these sort of mental stops, like Tony just spoke to, is like the last thing you want to do is see these options if the market just goes sideways or you know, goes down a little bit, goes up a little bit. They're just going to start decaying, right? They're going to start decaying a lot quicker as you get closer to that expiration. But I'm choosing November because I wanted to cover earnings. I wanted to cover economic data. I wanted to cover some of these Fed meetings that we're going to have here. So for me, I'm thinking about it as a hedge. Now, if this ETF starts going in my direction, starts going lower, I might look to do something these guys are going to talk about, to sell a lower strike option against the one I own and create a spread. So that's my trade here. That's how I'm thinking about it. And I want to use a mental stop to some degree, maybe 50% of the premium that I'm spending right now.
That's a great setup, because I want to talk to our in-house risk manager, Henry Schwartz. Henry, let's bring up the simulated return. So what I've done, I've basically, the 582 put in November, we've added that to the order ticket. You can see, you know, basically this is going to cost us $1,600 if we were going to trade this. Let's go to the new simulated returns. Henry, very simply, explain to us what factors are helping us on this trade, what are hurting us.
Sure. So, you know, and I love the premise, you know, markets at all-time highs. You know, anybody that asks me, I'm like, you got to stay invested. However, it might be a nice time to take a few chips off the table in some form, and a simple put hedge is one way to do it. When you're looking at the scenario, you know, the market can go down faster, can go down slow, and volatility can move on you, right? If you're long an option, you want volatility to spike, and what we tend to see in a shock, you know, if something really bad happens and we have, you know, a 10% down move in a day or a week, you're going to see volatility sharply higher. You know, the VIX will go from 15 to 30 is what we saw in April. And so that's going to be working for you. And, you know, the trick, and I agree with Dan, the trick here is if you do get the kind of move that you're looking for, that you're positioning for, you got to monetize it. You got to adjust it. Either take it, and in some cases you take it, you plow it right back into the longs, or at least you basically try to kind of monetize that hedge. Maybe you want to keep a little bit of short exposure on, but take some of those chips off the table.
And this is the beauty of simulated returns, guys, is you can see in real time what the value of your option is doing with this curved line. Meanwhile, you've got the hockey stick, the sort of textbook shape of a long put. That's what our P&L would be at expiration. And if you want to see that, the first thing you do is we can just advance time all the way to expiration. And this is probably the risk curve everyone's used to seeing on Robinhood, on the order ticket, on simulated returns. But really what's important is this trade's got how many days to expiration day? We got till November. We want to know what this thing's doing now. And that's where simulated returns is going to tell us, all right, what if we get you know, a $10 move down to 572? Let's get our mouse right there, and then let's click that. And you can see our estimated P&L, if today we got a $10 move in Qs for some reason, we'd be up $500 on this. Now, Henry mentioned if implied volatility increases. This is a brand new feature, and honestly, this is really what drives options prices. You have to understand implied volatility, and you can't see it because our friend, we've got Dan in front of us, but down in the bottom corner, you've got this slider. Tony, Q's implied volatility right now, 19%, relatively low. What might a spike look like if we got a bit of a correction that maybe Carter had mentioned earlier during his analysis?
Yeah, exactly. So this is the tricky part, right? It's really hard to answer that question, but you have to look at kind of where implied vol has been, let's say, over the last year, and that'll give you a good sense of the range, right? And you can look at kind of what the range of implied vol for QQQ has been over the last year, and that'll give you a good sense for, so right now we're at the IV's at 18%. You see the high end of the range is 52. So, if we had a $10 down day today, I don't think we're going to hit 52, but we'll probably get closer around 30 or so. So that's where you can use that adjuster at the bottom of your screen.
You say 30?
30.
30, all right. So
slide it over to 30%, and you'll see instead of making $500 on the trade, we'll be able to calculate what the new P&L would be if the stock went down 10% and implied vol went up to 30.
So notice as I do that what happens. Our theoretical P&L, which was sitting at roughly $500-something if we got this move, as we go and increase in implied volatility, look at our P&L, right? It is going up. It is almost triple, and the stock and the ETF price hasn't moved. And essentially, what implied volatility is, if you have no idea what that concept is, it's simply traders bidding the price of those options up, and we're using the options pricing model to derive that implied volatility. So if we get this is sort of a great setup. If we get a sell-off, we typically should see implied volatility pop with that, and we would get a pop in our P&L. So anything else we want to do on this trade, guys? This is pretty straightforward. We want the ETF to go down. We want implied volatility to pop. Carter's technical is showing us maybe we're at a double top and we're due for a retracement. Any thoughts on the trade? Should we put this on? We got a question in the back. Come on up. We got a microphone right here for you. Say your name and let us know your question.
My name's Dan. Thank you, gentlemen, for all presenting this. I think most of us, not the straddle, but picking a side of the trade, if I decide to sell that put to Dan, I'd expect that in a retirement account where we should be trading options because we can avoid the ordinary income, I'm going to have to put up the cash of $580 to cover that option.
Yep.
But I'm also expecting Robinhood right now is going to pay me about 4.5% cash on that cash sitting there while Dan is holding my option. Can you tell us how that works and how we see it? Because if you're going to sell the put, the interest income is a significant component.
Yep.
Thank you.
Well, here's the cool thing, right? If we take this order ticket and we switch this to sell to open, simulated returns is going to adjust that in real time. So our profit is your risk, and Dan, our risk is his profit.
I love it. I love it. I just want to make one other point about this kind of trade idea, and I know these guys agree. You really want to be tactical with hedges. You don't want to be doing this every month. It would be a big drag, right, on your performance. And so the reason why I laid this out and why I looked out to a couple months here is I think there's going to be a lot of action in the next couple months. And I think the way vols have come in a bit, it makes it a little bit more interesting for me to hold on premium, but also think about it as a hedge versus my portfolio.
All right, last thing, and then we'll put this trade on. Tony, Henry, what is sort of, we talked about this idea of mental stops, and I talk to a lot of retail traders that say, I want to put an actual stop on this. What's the risk to that?
Well, in options, stops can be tricky, especially if you get a dislocation, right? A stop market order is just saying if it hits this price, I need to either buy it or sell it. In this case, if you're saying I want to stop loss, and you bought this thing for $3, and you say, you know what, if it gets down to $1.50, I'm out. That $1.50 is your stop, but when that market fires, okay, you're going to hit whatever bid is there, right? Now, in general, the option markets are incredibly liquid, except for there are times where markets get wacky. April 2nd, April 9th are pretty good examples. So you have to be very careful. Stop limits are a little bit safer than stop market orders. But it's, in terms of, we talk about, the modeling and kind of the way we manage trades, you do have to keep in mind there are weird things that happen every once in a while. Dislocations are one of the big ones. And so, things don't always go, we can say, yes, we're going to stop ourselves out at $1.50, but you may only get a fill of $1.40 or $1.35 if the market is ripping higher at that moment. It's something to be aware of.
Yeah, and the rule of thumb that we usually have with like a debit type trade like this, whether you're long a call, long a put, or maybe a debit spread, is if you lose 50% of what you've paid for a long option, it's usually a time to reconsider that trade and potentially close out your trade at a loss and move on to the next trade. Because once you've lost 50% of the trade, the chances of the stock going back to your break-even price within the time frame that you're expecting it to is pretty low. You're better off saving the 50%, moving on to the next trade.
Yeah, and you can model that, guys, and then we're going to keep moving on and get to the next trade here. But let's say we move ahead, about a week or so, a couple weeks, maybe halfway through the life of this trade. You can see as time goes by, that theta is going to bleed out of that option. And now what was initially, like let's say we get a couple dollar move down in our direction that we want. Now we're up 300 bucks. But if we advance time, there goes our theta, and we start bleeding that away, and we start getting into negative territory. So we need the ETF to move. We need it to move a lot. We need it to move before time goes by, and we'd love to see a little pop in implied volatility. Otherwise, if this option goes from $16 to $8, we set a mental alert. We go in, we put a limit order to get out, and that way we sort of avoid the risk of using an actual stop order, which might give us a kind of poor fill. On Qs, it wouldn't be so bad, but maybe other stocks you're looking at, the liquidity is a little rough. So with that, guys, we've got the market trading 1644 mid, 1647 offered. What do we just hit the offer and move on here? All right, so we're going to buy that put, and we're filled. All right, so we're long the 582 put in November. Next trade, Microsoft. This is a stock, Dan. Recently had earnings. The tech stocks really just sort of, I don't know, what do you say about it?
Well, all right, so this was the poster child, right? Other than NVIDIA, this is the one that's accrued the most market cap since generative AI became a theme in the market, right, in early 2023. And when you think about their installed base, you think about the relationship with OpenAI, their ability to kind of integrate that technology into a bunch of their products that they hope to resell, right, to their customers, to upsell them. So we all know the story, and at this point there's been a lot of trepidation or a lot of concern about the ability for these companies that have been spending 25% of their revenue on CapEx, right? So what are they doing? They're buying GPUs, they're putting them into servers, they're putting those servers into data centers, they're training those models, right? And hopefully they're going to build applications on top of that, and they're going to monetize that by selling them to their customers, right? Well, we've had 2 consecutive massive beats over the last couple of quarters. The stock broke out to an all-time high. I'll let Carter talk about the chart. But since it's come in about 10%, right, some of that money has moved into some other stories. Maybe it's Google. Maybe it's obviously Oracle right now. Broadcom, is that a big thing? So I'm looking at this and saying, the stock is now starting to kind of chill out a little bit. I'm looking at expected earnings and growth, about 15% of earnings growth, sales growth for the next couple of years. It's trading like 2x like that. I think that's a reasonable multiple. Let's just see how this stock trades into its earnings October 30th. I might think about a call spread here because I think if they put up another good quarter, I think this stock's going to be moving back towards its highs.
Carter, I got a question for you real quick.
Yep.
This is a stock, you've got some levels, John, we'll get to that. Peak from the bottom of the tariffs to the peak high, we were up, is that 61%? Is that a real number?
Incredible, right? So it's always a question of where you start to measure. Do you measure from the low? That's an excessive move. Or do you measure from the level it was before it plunged? It's not up that much. But I think the key data point here is that we have 2 gaps. Dan referred to that. You see the one in May, and then you see the most recent one. That was a Thursday. It was July 31st. And if we were to maybe tighten the chart up, you'll see that, of course, it closed very poorly, that big red bar, closed on the absolute low, so a bit of an exhaustion day. And now we're down about 11%. The question is, the preceding move was fairly steep and uncorrected, yes, from the April low, up some 60+%. Is this lilting, quiet 6-7 week pullback enough to have corrected what was in principle incorrect? Right? It's in the etymology of the word. Corrections aren't bad, they're good. If it's a correction, what does that mean? That something was incorrect. It was steep, overdone, uncorrected. This stock is now corrected. The question is, and this is the risk, do you step in here and then it corrects further? No one has the answer to that. So you go in increments. With new money, I would start a position and take it from there.
Carter, question for you as well. I watch a lot of your work. You have a 150-day moving average on your charts. What's special about that? I know a lot of people look at 5,200. What is about the 150 to you that is important?
Sure, it's a big subject. You could have an entire conference on it. And let me just say this, that the 200-day moving average is the default on almost every program. It's the default in Investors Business Daily and most Wall Street firms. Its efficacy, and I can invite you to try your own studies, versus the 150-day is very low. So if you're going to measure trend, try the 150-day moving average and get back to me. But where it is now is interesting, right? It's coming up to where support comes into play, right? You measure support from a level before the breakout, and the stock is now approaching that level. The 150-day will move into where support comes into play in the following coming 10, 12 days. I would start here if you have none, and on any incremental weakness, I would buy more.
All right, so Dan, let's build a trade.
Yeah. All right, let's think about defined risk, right? And I think what Carter just mentioned about that huge gap after last earnings, but how poorly it closed, right? And so there's something there that investors are kind of, you know, they're keying on a little bit. But I like his levels. I like the potential for this thing to kind of rally back, especially if we're going to see a re-broadening out of this AI trade. So I want to look to November expiration again. These guys might have something to say about that. But I also want to catch their earnings. I think they're supposed to be the day before Halloween or something like that. So, and I'm going to go a little out of the money here, Obi. I want to look at the November 520 call. That call, I think, is offered. What do you got of that right there?
1370 offered.
Okay, 1370 offer. And I want to look up that prior all-time high intraday on the day after their earnings was 555. And I want to look to sell, let's say, the 560 call. So I'm buying the 520. I'm selling the 560. I'm creating a call spread. I can only lose the money that I put up here. So if that 560 call, what do you see that bid, Obi?
It's say that again.
What's the bid on that, the 560 call?
560 call is 385 bid.
Okay, so let's call that spread $10, right? Buying the 520, selling the 560, cost me 10, excuse me. It breaks even at 530. I have gains from 530 to 560. That's my max gain at 560, but I'm only risking $10. Now you might say, that's a bit out of the money. But what I'm trying to do is kind of reorient myself with that range that we saw, you know, from earnings, from the breakout to earnings on the way back. So I like the idea of using a call spread here. And again, I'm going to use a mental stop, probably about $5 to the downside. If you think about $5 and you can stick to that spread and you were wrong, that is 1% of the stock. So that's why I like this trade idea.
So Tony, let's bring up simulated returns, and here's the standard shape of a long call spread, call debit spread. You might hear it as a long call vertical, bull call spread. It's all the same thing. How has selling this option further out of the money changed the dynamic compared to the last trade we did, where, of course, it was a bearish trade, but let's flip that for a second. Owning an option, we need the price to move. We need it to go before time decays, and we want to pop an implied volatility. What is that like when you add in selling an option and turning into a vertical spread?
Yeah, so this is a great example of when you want bullish exposure to the upside, but you want to do it either with smaller defined risk, or you think that there's somewhat of a limit as far as how much this stock can move up by between now and that November expiration. And I think November is a great expiration to use to try to take advantage of the next catalyst, the next earnings coming up. So by selling the 560 calls, we're here collecting about $3.80 versus around $13.70 for the long call option. So if you think about it, if you just bought the long call option, you're risking roughly $1,300.70 per contract just to buy one of that 520 call. But by selling that 560 call and you're collecting nearly $4, you're reducing your overall risk on the trade by about $400. So that's $400 per contract that that's $400 less in capital that you need to get into the trade, and that's $400 less of risk per contract. And that's going to be reducing your overall risk on the trade. And if the trade does move in your favor, that's going to leverage your upside potential. So you're risking less, $400 to the downside. And then because you're risking less, you're going to make more if the stock does move up to that 560 range on the upper strike. And it just happens to be the 560 strike is around a 15 to 16 delta. That means that's roughly 1 standard deviation away. That's roughly the expected move. And that's going to line up very well. So you have a 560 level that lines up both with the resistance level, the technical level. So you're being tactical about selecting your strike prices. And you're also using a probability-based approach to select your strike prices. And that's going to be a more consistent result when you use these types of strategies, is you want to use some type of method to picking that upper strike. And I usually like it to use a probability-based approach unless you have an important technical level. But here you actually have really nice alignment across both.
You know, Tony, an old trader, a friend of mine, taught me, like, even if you didn't have all these tools, let's say you didn't have any information in front of you and you had a call spread, where do you want the stock to go? And the tip I was taught was, you want it to go to the short strike. That's it. In this case, we want Microsoft to go to 560 before expiration, and if we look at what happens on the simulated returns, once it gets there, at expiration, our profit is capped. Now, some might say, why would you cap your profit? Tony mentioned about reducing the capital Henry. That also lowers our break even. Tell us about that, and then I want to show off something on the option chain as you're discussing that.
Well, and I think that very importantly, what you're doing is you're expressing a view, not just Microsoft's going to go up, but Microsoft is going to go up this much. As Tony said, you know, there's a kind of a quantitative basis for that. But even if there's no quantitative basis, if you came in thinking Oracle would be up, 30% this morning, there was a call spread that would have been the most efficient use of your capital for that. And so in terms of break even and just really the best use of your money is you are saying, yes, I think Microsoft's going to go up, but you're also, you really are expressing, I think it's going to go up this far. Because if you think it's going to go up a lot further than that, you'd actually be better off picking an even higher strike or maybe doing an entirely higher call spread strike to begin with. And so, the kind of the amazing thing about options and the fact that we've got great liquidity across actually 1.5 million option strikes are what's available to trade from these days, is that you can basically define, this is what I believe is going to happen, this is how much money I'm willing to put into the trade, and then you can put it on.
And just to compare the two, right, just to put some numbers, and this is assuming that this goes all the way at expiration. If you just bought the 520 strike and the stock hits 560 at expiration, so we hit our target at expiration, you're looking at around $2,600 worth of profit on the long call option. If you just bought the call option, that's 190% return. But if you traded this vertical and the stock went to 560 at expiration, you're looking at a 305% return. 190 versus 305. That's how big of a difference that $400 saves you by selling that 560 strike. So just think about that. 190% return versus 305. That's how big of a difference that $400 will save you. And that's why in a lot of cases, when you think that there's a limit as far as how much this stock can move to the upside, using a vertical many times is the best strategy.
And one of the things I love about the simulated returns is everyone thinks, well, when you are a net buyer of options, time is always working against you. Not necessarily the case here. You notice we have the price of the option or the spread when it's below our break even. Time is hurting us. But if we got that move and we broke through that break even price, now that short option becomes the dominant option and time starts working in our favor. So let's say we got a big move to 560, and we're just sort of waiting for time to go to expiration. As we move the time slider, you see our profit goes up as time goes by, even though we're paying for this spread. And that's just a little, visualization how option Greeks work, options pricing models work, and then more importantly, we're lowering our break even. So if we go back to the option chain, you can see the break even price if we just bought this 520 call is 533.68. Well, we're collecting almost $4 in premium to sell that, so subtract $4 from this break even. Now our break even is about 528, 529. So there's some benefits here. Stocks don't always go up forever, and to Dan's trade here, we think that 560 might be a level that, hey, that's where maybe it'll get exhausted and we can kind of get a bang for our buck there. So in the interest of time, we like this trade. Shall we put it on? Yeah. All right, let's reset the market on this, Dan. It's trading about 990. Let's just be aggressive. We're going to go above the offer price to get a fill. And you guys, your order ticket has mid-market. It has the ask price. We know some people have trouble getting spreads filled. sort of a best practice is maybe start at mid-price, work your way up. In this case, we want to get filled, so we're going to pay above the offer price. We're putting this on, risking $1,000 to make potentially 3. And hopefully, and look at that, we're filled. All right, trade 2 in. All right, we got 24 minutes left. If there's any questions going on, please come up to the mics. We'll try to answer that. Trade 3, Dan.
What are we doing?
Your favorite.
Oh, Tesla. All right, let's do it.
We got a question from Esmond. We're going to talk Tesla here in a second. Esmond, everyone calling Esmond from Hawaii.
Oh, is it on now? Hey, aloha everybody. Hey, Aole Pilikia. Good job, bro. Yeah, so my question's from earlier, though, so I apologize. I know that we don't recommend using stops on this kind of stuff. Do we think that Cortex will be able to do it for us?
Well, it's a good question. I would say, placing a stop order is pretty simple.
Yeah.
The risk, of course, as Henry pointed out, is, especially on a spread, I personally would never use a stop market order on a spread. Always use limit orders. Sure. But on a single option, your risk is that when that price gets triggered, the market widens out, there's illiquidity, and so the price of your stop gets filled at a much worse price than you thought. So just personally, I don't know about you guys, I just like to use limit orders and get my hands on the order.
Just a follow-up. Do you think Cortex will increase the speed we'll be able to do this kind of stuff as individuals at home?
I think there's a lot of potential. I think what we saw last night is only scratching the surface on what Cortex can do. I mean, as Swaroon mentioned, that product is still being developed and worked on. So I think what we saw last night is only the start. And I think it's only going to get better.
Awesome. Mahalo, gang. Thanks for listening.
Thanks, Esmond. All right, next trade, Dan, Tesla, your favorite.
Yeah. All right. I'll just set this up because I think these guys have some views about the trade idea. To me, if you look at the performance, and we can maybe throw that chart up. Let's do 1 year. Whoa, look at that, baby. And you see, let's go back 5 years. So this stock was added to the S&P 500, I want to say in late 2020. The stock went from 300 to 400 in a straight line. You see what happened since then. It started to underperform, not just its peers, but the broad market. What was going on there? Something fundamental. They were starting to lose market share in China. They were starting to kind of lose market share here in the U.S. They were seeing more competition. There was a price war that was started. They saw their margins that they enjoyed, which were well above traditional auto margins because they were making a great car and they were getting a lot of leverage on that. They were seeing them kind of hang in there. And so price war starts. China's taking market share in China. This was a big market for them. The story, in my opinion, has been a bit of a train wreck. I think the best days for their EV business are behind them. But if you believe in robots, if you believe in robo-taxi, if you believe, there you go, have a ball. If you believe in that hunk of junk, that big, whatever that thing is, get in there. All right, but I don't believe such things, and maybe you talk to us a little bit about the chart. I just think that this, if it's being valued on robots that are not going to come for a while, robo-taxi that's going to take a long time to scale, the amount of money that it's going to take to get that to scale, I think this stock is going to be stuck in the mud.
All right, well, I mean, so look, you can draw the lines any way you want, just as you'll have a fund unless have a buy rating on Tesla. It's subjective, and one will have a sell. But this is what my eye sees. We know we're at a moment of equilibrium. So the stock post-election surges. There it is. You see that. It hits 488. And then it proceeds to lose 50% of its value, plunging rapidly, giving back all that and then some. And now we're sitting what they call in the apex of this formation, converging trend lines. And it is literally what a coin toss is. So the word I use is a pair of twos, which means it's a very low hand bet in poker. When you have a big bet, you bet big. When it's the pair of twos, the only thing you have worse than that is 5 random cards. And so you have to either stay away or make a bet which way this inflects. My hunch is it goes higher, that it moves out of this formation to the upside, but that's subjective. And to each his own.
Tony, I know you're going to build a trade first on this one. Now, we know Dan's a perma bear on Tesla. It's fine. It's what I love about him. Tony, we're going to do a bullish trade on this. So we're going to sell some premium here. Take us through the process. We walked through how to buy a spread. Take the other side of the trade. How do we sell a spread?
Yeah, so in this particular case, like Carter's charts here, you've got this stock heading into an apex, but it hasn't broken out yet, right? So before a stock breaks out, I don't particularly like to be long options because time value is working against me. So in this particular case, I like to be selling some premium, wait for the potential breakout. If it does break out, then I'll look at buying some maybe call options or call spreads like we just did on Microsoft. So for now, I think the better trade to do is to sell. So right now, I'd like to go out to the October monthly expirations. And when I'm selling a spread here, I typically like to be fairly aggressive. I like to sell strike prices that are very close to the current price of the stock. That's going to maximize the amount of income that I collect on this particular trade. So if let's say we sell the October 350s, that'll bring in roughly a little over $18.50. Now, if I were to just outright sell this 350 put strike on Tesla, the capital required is around $35,000 just to sell one single contract. That's a lot of margin that you're tying up just in this one contract. So in order to reduce the amount of risk that I'm taking and reduce the amount of margin, I'm going to buy back a lower strike. I'm going to look at buying the 325s. I usually like to go around a 25 delta when I'm using these types of strikes. And if you buy the 325s, I'm looking at about $9.75 in credit that I'm collecting on a $25 wide credit spread. So whenever you're trading a credit spread, whatever you bring in terms of a credit, the rest of the width is your total risk. So the more credit you bring in, the less risk you're taking. So if I'm taking this on for $9.77, my total risk on this trade is just a little over $15. That's about a 1 to 1.5 risk-reward ratio. A lot of credit spreads, you'll see, you'll get 2 to 1, 3 to 1. I don't like those types of odds when I'm selling for premium. I like to reduce my overall risk down to $1,500 versus $35,000. If you just sold the put, you're reducing the amount of margin from $35,000 to $1,500 per contract, and now you have about a 1.5 to 1 risk-reward ratio. So if Tesla just sits where it is right now, you could potentially make around $1,000 per contract. If it drops below 325, that basically gets it to the bottom end of that triangle. Then in that worst case scenario or lower, I'm losing $1,500. So that's the type of trade structure that I like to use when I'm selling a put spread here.
Henry, I'm noticing something about this shape. It looks pretty darn similar to what we were just doing with a long call spread. In 30 seconds, explain to us, long call spread, short put spread, two different strategies, same risk profile. What gives?
They are the same risk profile because of put-call parity. So basically, if you think about it, if you buy a put and you buy the stock, you actually have the exact same risk of just buying a call. Okay? And you have to think about that when you're doing an overwrite, because when you buy the stock and sell a call, you actually have the same risk of buying a put. So, you know, for the geeky quants, there actually is no difference between a long call spread and a short put spread. In fact, if you put the two together, you get a box. And so it all kind of has to work out. And I actually kind of like this trade as well. You know, it's a way to kind of be in the stock, but in a kind of a very subtle way. It's like, I think this is going to happen. If it doesn't, you know, worst case is I lost basically what I thought I was going to gain.
Yeah, I would just say one thing about that. If you think, Carter just said he thinks it's a pair of twos, that's a great strategy to kind of take advantage. I want to say one thing about this story. You know, there's not too frequently in the market where you'll see the bulls and the bears in one name agree on something. They agree that the EV business is not the reason to buy this stock. And I think that's really important. The other thing I'll say is that chart, if I didn't know it was Tesla, I think it's a good looking chart. I mean, like if you look at that series of kind of, you know, higher lows, you see that tension that's building there, the potential for a breakout. So, you know, not always from a bear. Oh, last thing, they're going to report Q3 deliveries the first day or two of October, and it's been a mover on that. And they're actually likely to be good. That tax credit is going away, that $7,500. So they might have pulled forward a lot of demand. So I just think that's an interesting part of the setup.
All right, guys. So we've got a short put spread. We're collecting roughly $10, give or take. You can see on the order ticket our max profit is the credit received. So if you're not used to selling options, when you sell options, the most you can make is the credit. But the trade-off is we have a higher theoretical probability of success. In this case, and I'm going to bring this up, if you don't know that this is available, go to your option chain, customize columns, and we have two data points, chance of profit long, chance of profit short. And if we bring that on our option chain, and I'm going to drag these over so it's closer to the actual price here. There they are. You can see the chance of profit if we sell this 350 put alone, Tony, is 65%, which means our break even after we buy the 325 is 340.25. So if we kind of just go to that 340 strike, what's the probability of this option staying out of the money? I'm going to add one more column to our option chain, probability of out of the money. And the 340 strike, which is right around our break even, let's clean that up. We've got about a 58%, we'll call it 60% probability of success. Now, that's theoretical, where if we were saying buying a similar strike out of the money, let's do the math. Let's say we bought the 370 call, our chance of profit long is only 26%. So you can see as you start building these strategies and understanding selling premium versus buying it, using the simulated returns, you can increase your theoretical probability of success while still giving our chance to make a decent amount of profit on this trade, Tony. So what do we think, guys? Let's hit it.
Sold.
All right. Market right now is 955 bid, mid-price 972. Let's give up a little bit of that credit. I'm going to go between the bid price and the mid price. We'll call it 965. Let's see if we get a fill. All right, market makers are good today. So we're filled on the 325, 350 put spread. We got 13 minutes left. We're entering the lightning round. We might lose my trade, but we're definitely going to do Henry's next trade. How many people here trade 0 DTE? When you do 0 DTE, are you a buyer of options? Raise your hand. Are you a seller of options? Kind of 50-50. All right, we're gonna do something pretty gnarly here. Anyone trade an iron condor before? Okay. Henry, take us through the trade. I'm going to bring up SPX, which is the S&P 500 index.
Absolutely. So you heard Kathy Clay earlier mention the SPX and that literally half of the activity trading in this index is retail. The 0 DTE phenomena that we've seen in the last couple of years has really been kind of mind-blowing. 62% of SPX is trading in zero-day options, okay? So I used to be a market maker many years ago, and I have kind of a lean towards selling premium, okay? I kind of believe that structurally options are a little bit overpriced. So the trade that I want to do, and the trade that is actually one of the most popular trades we see in the SPX 0 DTE, is an iron condor, a short iron condor. Sounds complicated. You know, Obi said this, you know, it's the most complicated. It's really not. It's a put spread and it's a call spread, okay? And we're going to pick two levels that are out of the money by enough to kind of give me what I feel like is a comfort zone. The way I like to think about this is a simple risk reward. In fact, I don't look at volatility when you're talking about 0 DTE options. It's much more binary. It's basically a line in the sand. Okay, so SPX right now is at 36.61. Sorry, 65.36. I'm looking at something else. Where do we think it's going to close today? Because these options expire in 3.5 hours. Okay, so you can see basically, you know, further out of the money, you're going to get less for the calls or the puts. But what I like to look for is a 10-point put spread and a 10-point call spread with $1 of premium if I'm doing a midday trade on each one, okay? So basically you have like a 9-to-1 risk reward for the put spread and a 9-to-1 risk reward for the call spread, okay? But keep in mind, we can't expire both below and above any of those strikes. So only one of those spreads at a time is any potential to settle in the money. So if we look right now at the, say, the 65.10, 65.20 put spread, that expires today. Okay, it looks like you get about $1 for that one. And then on the call side, I'm looking at like the 65.50, 65.60 call spread. Okay, get about $1 for that as well. One of the things I love about Legend is like it does put the price right into the order ticket, and I just learned today you can click on the bid to refresh it. This is kind of right exactly where I like to do the trade. Now you have to be very aware of the risk you're taking, right? So, you know, if the market goes shooting one way or the other, okay, you're going to go through your short strike, and then your long strike is what protects you, okay? So in SPX, as a $6,500 index, The margin on a one lot is $650,000. So there's not a lot of naked option shorting going on in SPX, but there's a lot of spread trading. In fact, the condor trade is the most common one. So, and then if you look at the payoff profile, okay, this is a trade that lasts for the next 3 hours. You see what the sweet spot is. You basically see where you're going to make money. Okay, it's between the 65.20 and the 65.50 level. Right now, we're almost in the center. If you don't believe that the market's going to just kind of waffle along for the next couple hours, this isn't a good trade. You might even want to take the other side. But in this case, I would just sell this. And there are some people that like to sell them and then put stops and try to get out when they've hit kind of their total credit. I'm not a huge fan of that. I'd rather just do it very small and set it and forget it.
Yeah, I think you bring up a great point. Is every trade we've done today is risk defined. So here, if we sell this iron condor, Tony, we've got a max profit of 200, a max loss of 800. If we put this trade on and go about our day, these are cash settled options, so we don't have the worry of sort of the underlying being between our long and short strike or getting assigned or exercised, having pin risk or anything like that. So in this case, Tony, talk to us about how you would manage this throughout the day. Would you just sort of set and forget and kind of hope we kick this field goal between our two short strikes?
Yeah, so for these 0 days to expiration iron condors, I don't particularly like to set stops because they're defined risk anyway. I'm comfortable with the risk, or you should be comfortable with the risk when you put it on, at least for the number of contracts that you're trading. But I do like to take profits on these. I like to set limit orders on these. So for example, if the maximum gain on this is $200, I like to take profits if I get $100 in profit. So if between let's say in the next 2 hours, you could potentially make 200, but once you make 100, I'll take those profits and I run, because gamma gets really goes to infinity at expiration. So you could be up, $150 5 minutes before the close, and you get one small move in the underlying, and all of a sudden you're down $400 or $500. I don't like that risk in the last hour or so. So I like to, if I can, take off some premium at about 50% of the max profit.
That's such an important thing I want to point out here is manage your risk. All right, these are your positions. The amount of traders I see that carry positions into the close. When I was on the desk, Dan, it was hammered into my head. Manage your positions, manage them when you have that opportunity to, because what happens in those last 20, 30 minutes of the day, and now SPX is a little different, but equity options, you might get a tap on the shoulder from the risk manager. In this case, the Robinhood sellout process. We're going to manage your risk because it becomes our risk. So how do you approach getting out of a position, especially on one that's nearer, in this case, on the same day as expiration?
Yeah, you better be at your legend. I mean, that's a big part about it. And that's one of the things about this product, and I think Tony just kind of spoke to the fact why it's so popular. I just think that a lot of folks are staring at their screens all day, and they're looking at individual names, or looking at indices, and they're saying to themselves, there's really a lot of opportunity if I'm spending a lot of time in the markets. And I think these products are really interesting. But Tony, I have a question for you. What is the initial catalyst that might cause you to do a strategy like this? Is it something technical? Is it because you're just kind of staring at the markets and you see an opportunity? I'm just curious, like how does that idea kind of get in your head?
Yeah, for 0 days to expiration iron condor like this, there's usually two things, right? There's one that's volatility. So when volatility generally is high, it's a better environment for doing so. Right now, volatility is not particularly high. It's not the best environment to do it, but when you do get, when the market opens up and VIX is up, that's really a potential an opportunity where you get a little bit of a fade of volatility for that day. But the second thing I look for is usually a big intraday rally. When you get a big intraday rally, a lot of times after that rally is when things start to consolidate and move sideways. A lot of people think that when you see that the charts are narrowing down, that's a good time to sell iron condors. It's the exact opposite. When things are narrowing down, you have the potential for that explosion of volatility. That's not what you want. So it's after the explosion of volatility, that's when you might want to consider
I put up the intraday chart, Henry, here, and we see that, right? We see the pop at the start of the day here. And then this market just sort of drifting back and kind of consolidating sideways on this 5-minute chart. So, I think in this type of trade, Henry, you're just sort of looking to sell vol, and you kind of hope we kind of get stuck in the mud through the rest of the day, right?
That's exactly it. It's you're drawing your lines in the sand. You're saying, I think we're going to finish between these two levels. One of the interesting things about the 0 DTE activity, and as Tony mentioned, there are times where it's kind of a little better than others. A lot of people trading it sit out a Fed day, sit out a CPI day. But the great thing is, like, CPI comes out at 8:30 in the morning. You don't need to trade if the market's going to be insane. You can sit it out and say, I don't know what's happening out there. This is not the kind of trade I want to do. And we see that in the data, like, on April 9th, or you can go back to August 4th when the market imploded kind of on a Sunday night, the 0 DTE activity was very low because the traders that like this strategy, they said, no, I'm not kind of sticking my toes in this because I don't know what's going to happen. But I do like what Tony said. Taking profits can be great. Sometimes I just leave a 10-cent bid in the short leg, which you might get filled towards the end of the day. But it also, then your risk is actually positive because at that point the entire thing is kind of decayed. And in case you get something weird in the last 20 minutes of the day, you actually might get a positive surprise.
So what I've done on this intraday chart is I've drawn our short strikes. So in an iron condor, we want it to stay between our short strikes. And essentially, if we stay between 65.20, 65.50, this is one of my favorite things about this simulate returns tool is when we get into the 0-day expiry, our time slider in the bottom left, which once again is sort of sitting behind Carter, it changes from going from 1 day at a time to minute by minute. So as I slide this, I can move theta forward a minute at a time, and you can see if the index doesn't move and kind of stays between our short strikes, that theta is going to bleed out very quickly over the next few hours. And to Tony's point, maybe we can collect $2 here, but maybe we look to get out of this. Hey, if it's trading 160, or trading down to where we're making about 160, 180. Buy this back, take our risks off so we don't get any sort of weird end of the day moves, or like Henry does, just kind of set and forget.
Yeah.
All right. Any questions here? I think we're going to lose my last trade. So we got about three minutes for questions. Let's put this trade on. We've got a bid price of 185, so that's the most someone's willing to pay for this. We've got a mark price of 194, so we're probably going to have to collect a little bit less. Henry, what price would you put this order in at?
I'd go in $1.90. SPX trades in nickels because it's such a high-priced index. So
that's a very important point. Trading in nickels. So if we put this in at 190, 192, we get a reject essentially.
Exactly.
So let's put this in at 190. We're going to submit that. Sent to our friends on the floor, the SIBO or the machines. Guys, we've got 2 minutes left. We did 4 trades. Sorry we missed the 5th one. Maybe if we'll do that at the booth if you drag us by. But any questions in our last 2 minutes? We got a hand here. Why don't you see if you can run to the mic real quick. If not, speak very loud. If anyone else has a question, the lightning round has begun.
Hello. Yeah. Thank you. Privileged to watch in person. We've been watching in CNBC always. So the question I have is, this being like a tactical, we have been discussing about this tactical moving averages and in placing the trade. Predominantly, all the bigger institutions and all the tactical traders, they use same type of tactical analysis, right? So in that case, how it is going against the trade? How other than market news, major market news, why is it something majority of the trades sometimes it's going against for the people who takes a tactical trade? Because majority of institutions uses same tactical analysis.
I had a bit trouble hearing that because of the noise. Anyone pick that up?
Okay, I'll put it in a quick way. So majority of institutions and also the traders uses tactical analysis for them. In that case, how the trade is going against them? Because everybody uses the same kind of tactical analysis.
So I think the question is between institutional traders, retail, technical analysis, we're all looking at the same things. What sort of...
You're studying price action. But the question is, what's the difference between those two, or what do you do if a trade goes against you?
Yeah. So why it is going against the tactical analysis, most of the cases, other than the market news?
All right, well, yeah, what's moving besides just market news, flows?
Yeah, I mean, look, everything that's known and knowable is in the marketplace, and people react to news. Most big moves are news-related. You get FDA approval, stock gaps up. You miss, it gaps down. Your earnings beat or miss. And so most resets up and down are technical because people lurch forward or backward to re-rate a stock in relation to what just was said. But in terms of when you're wrong, you know what to do. There's nothing wrong with being wrong. Just get out. But I'm not sure that answers your question. You were trying to make a distinction between retail and institutional?
Hello? Yeah. So
why don't we find you afterwards?
Yeah,
and
sure.
We'll hang out and chat.
Sure, thank you.
Guys, we are out of time. Did everyone enjoy this?
Yeah.
All right. I want to thank my panelists for Dan Nathan, Carter Worth, Tony Zhang, Henry Schwartz. I'm Michael Obacina. That was Tools of the Trade. Thanks for hanging out with us. Now back to the stage. I think Steve Quirk